Ladies and gentlemen, good day and welcome to Mahindra Lifespace Developers Limited Q3 FY22 Earnings Conference Call. We have with us on the call Mr. Arvind Subramanian, Managing Director and Chief Executive Officer, Mr. Vimal Agarwal, Chief Financial Officer, and Mr. Sumit Kasat, Head Investor Relations. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arvind Subramanian, Managing Director and Chief Executive Officer. Thank you, and over to you, sir.
Thank you very much, and good morning to everyone. Welcome to our Quarter 3 FY2022 earnings call. Firstly, I'd like to thank everyone for taking time to participate in this conference call. As you all know, many of our key operating entities in the residential business, like Mahindra Homes, Mahindra Happinest, and all the entities in our industrial business, which is Mahindra World City Developers, Mahindra World City Jaipur, Mahindra Industrial Parks Private Limited, Mahindra Industrial Parks Chennai Limited, all of these are not consolidated on a line-by-line basis. I wanted to start my opening remarks by drawing out 6 things I noticed in the recent budget, which I think has important bearing for us both as a category as well as us as a company. First, the continued commitment and focus on PMAY and affordable housing. I think that is a strong statement of intent. These are multi-year programs, and the fact that the government continues to support it aggressively is a good sign. Second, a strong investment focus. I think it was very clear the theme of this budget was around supply side, focus on manufacturing, focus on infrastructure. So particularly the focus around the manufacturing sector was very notable. The expansion of the PLI schemes, the focus on solar panel, solar module manufacturing, infrastructure status for data centers. These all bode well for our IC and IC business. Third, the promise of new legislation on the SEZs, which again is something that has been discussed for a few years now, and we are hoping that the new legislation creates a liberalized SEZ environment. As you're aware, we have a significant presence in the SEZ space, particularly now in Mahindra World City Jaipur. And depending on how this legislation shapes up, I think again it could be a big positive for us as a company. Fourth, the entire budget there were repeated references and commitments to sustainability and green, which again I think it's important for the nation, it's important for the category, and certainly it's an area that we like to think of ourselves as leaders in within the real estate peer group, and therefore again plays to our strengths. Fifth, there was a lot of talk about in different aspects about building transparency with the national generic document registration system, the digitization of land titles, etc., but also the easing of approvals and single window expedited clearances around the environmental clearances, etc. And the last one I will call out is the focus on infrastructure, particularly roads and highways. And that, to my mind, while it is of course very good for the nation and creates a strong economy, it does have some risks for us from an input cost perspective, because as more and more investment happens in roads, cement, steel demand, etc. goes up. So these are 6 things I would like you to bear in mind as we as you look at the category as well as the company. The sector overall has been doing. Many analysts, some of you on the call have been writing about the signs that this may be the start of a multi-year bull run for the sector, and I do believe that that view does merit consideration. The pandemic has had a strange impact, which is almost counterintuitive. When the pandemic started, we wouldn't have thought of it that way, but looking back, we are seeing that paradoxically it has reignited the need for better personal spaces, homes, offices, etc. in the home buyer's mind. And despite the recent spread, almost viral spread of the Omicron variant, we are seeing a steady improvement in both consumer sentiment as well as business confidence. I think this is backed by the strong vaccination drive and the fact that many states are now starting to gradually open up some of the restrictions that were placed. The historically low interest rates, greater affordability, high savings rates, and as I said, a resurgent interest in home buying are all good tailwinds for the sector. Price levels are recording a perceptible uptick, both on a quarter-by-quarter but also on a year-on-year basis, and I expect this trend to continue in the coming quarters. This is driven by both demand strength and also the input cost inflation. Let me take a cue from two aspects that I highlighted in the budget, the focus on manufacturing and the SEZ legislation, to actually start my comments about our performance with the IC and IC business rather than the residential business, which I traditionally do. And the reason I picked the IC and IC business to talk about first is, to my mind, that has been the standout highlight of the Q3 performance. I have been talking for the last few quarters about the fact that we've seen a good pipeline, a good build-up of inquiries, but we've been struggling with conversions primarily because international travel has been restricted. As some of those restrictions eased in Q3, we have seen a strong conversion and done 51.1 acres of leasing in Jaipur, totaling to about 143 crores. And the good thing about this, two or three positives I would take from this. You would recall I had set an aspiration that by 2025 we need to be at 500 crores per annum of industrial leasing. So doing 140 crores in a quarter sets us very well on that run rate. The other aspect is this is a long sales cycle business. So, I have confidence that that performance will be sustained in the current quarter as well. And the third is, again, going back to a more general observation, I think the resurgence of manufacturing investment bodes well for the overall economy and for the country. So for all these three reasons, I'm very heartened by it. It's also a testament to what Rajaram and his team have been able to achieve over the last 6 months. You would recall Rajaram joined us as Chief Business Officer Industrial earlier this year. And his focus along with his team has been to build a discipline in our sales process so that we have predictable business. This tends to be a very lumpy business, but he and his team have been building the foundation to make this into a more predictable quarter-on-quarter business in the quarters to come. So kudos to Rajaram and the team. Turning our attention to the residential business, we had again a very strong quarter, about 250 crores of pre-sales, largely driven by, in fact entirely driven by sustenance sales. And that's again been an important focus that Mahindra has brought in, where we don't want to be only running from launch to launch. Of course, launches are important, and I will cover that in a minute. But it's important to build the capabilities to continue to chug along with sales, even in periods when we have fewer launches. So that does wonders for our economics. So 250 crores of pre-sales in the quarter. Our 9-month sales comes to about 700 crores, which is higher than the entire previous year, what we achieved in FY21. The major contributors from a value perspective were Luminaire in NCR in Gurgaon and Vicino in Mumbai. Both projects have done extremely well. Luminaire has again been a very heartening story. We've seen over a 20% price appreciation over the past 18 months. From a volume perspective, Mahindra Happinest, Mahindra World City Chennai was a standout performer. We launched about 348 units in Q2. This was, I think, in August, September when we had launched it. As we stand today, we've sold 97% of that, which again is a great testament to the capabilities, because we're now able to demonstrate this project after project, which is fantastic. During the quarter, our mid-premium business or mid-market business contributed 72% to our sales value, and the affordable business contributed to 28%. And the average price realization stood at just under 7,900 rupees per square foot. That's driven largely by the mix of mid-market versus value homes. Coming to launches, in the third quarter, we launched a new phase at Alcove, which is our project in Sakinaka in Mumbai, as well as the last block of Happinest Avadi. And we've also relaunched and with a significant upgrade our villa project in Alibag. We now call it Mahindra Meridian, and the initial response has been very heartening to that product as well. Looking ahead, we just 2 days back, just this weekend, launched our second project in Kalyan. This is a land parcel we had acquired in March of 2021. So it's been about 10 months that we've taken to get to launch. And the first weekend walk-ins have been quite encouraging. Looking ahead, we are looking to launch additional phases in Happinest Tathode in Pune, the last phase of Alcove in Sakinaka, as well as Vicino in Andheri East. We are also in advanced stages of RERA registration of the last tower in Luminaire, which is Tower B. Our project in Kanakpura, as well as the new land parcel that we acquired in Pune in Pimpri, will both be launched likely in the first half of next year. We are also looking to launch a plotted development project in Mahindra World City Chennai, where again we expect approvals and to be able to launch it within the first half of next year. The overall inventory that we expect to launch in the next 3 quarters, which is Q4 of this year and Q1 and Q2 of next financial year, will be in the range of about 1,700 crores. Land acquisition is an important area of focus for the management team. This year so far we have announced 2 land transactions with a total GDV of 1,300 crores roughly. One in Pimpri, as I mentioned, and one in Dahisar in Mumbai. Both of these are progressing well from a design development and approvals perspective. We are in advanced stages of negotiations on a few other important land parcels and should be able to make announcements in the next 2 to 3 months on totaling a GDV of about 2,000 crores. That will take us well above the target I had shared with you of doing 2,000 crores worth of GDV addition every year. So I'm very confident we will exceed that. If I look further ahead, our overall pipeline from a business development perspective, land acquisition perspective, is almost 8,000 crores worth of GDV, and this covers many different deal types. We are now actively pursuing transactions which are outright with approvals, joint developments, society redevelopments, as well as distressed assets. So if we look at that 8,000 crore pipeline, these are in various stages of negotiation. Even if we hit a 25 to 30% strike rate, we are home and dry for next year's land acquisition as well. We would like to exceed that, but I'd like to give you confidence that we are in a good space as far as land acquisition is concerned. Collections and cash, another important aspect of our business. In Q3, we achieved 469 crores of collections, which has led to an overall year-to-date collections up to end of Q3 of 844 crores, which again is well above what we achieved in the full FY21. So we have a very good, strong cash position and a low leverage on our balance sheet, which sets us up well for growth going forward. We completed about 2 lakh square feet during the quarter, primarily in Bloomdale and Nagpur and Happinest, Palghar. And the overall 9-month completions is about 7 lakh square feet. We are expecting a few more important completions in Q4 at Centralis, at Palghar, at Bloomdale, and at Lakewoods in Chennai. Overall, we are seeing construction activity picking up pace. The first 2 quarters we were lagging from our desired pace, but Q3 we've caught up, and Q4 we expect to end the year quite strong. With that, let me request Vimal to update you on the financial performance during the quarter.
Thank you, Arvind, and good morning, everyone. Moving on to the financial performance for Q3 FY22 as per India's basis of accounting, following are the 4 or 5 key points. The consolidated total income stood at 23.3 crore as against 65.7 crore in Q2 FY22 and as against 70.23 in Q3 FY21. The consolidated EBITDA, including other income and share of profit from JVs, stood at 21.4 crore as against 27.4 crore in Q2 FY22. This number was a loss of 2.9 crores in Q3 FY21. The consolidated PAT after non-controlling interest stood at 25 crore as against 6.5 crore in Q2 FY22 and as against loss of 11.2 crores in Q3 FY21. Your company has consolidated gross debt of 199 crores, while cash in hand and bank balance stood at 156 crores. The cost of debt is 7.2% on consolidated basis, while MLDL standalone debt is at 6.4%. With this, I request to move to the questions. Please. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. First question is from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good morning everyone and thanks for the opportunity. Arvind, as you alluded in your opening remarks on the business development pipeline, so just to clarify, so you're saying out of the 8,000 crores of pipeline deals, maybe around 2,000 crores is something you will close by March of this year, or it may spill over to next year? Just wanted some clarity there.
Yeah, so I think we are trying to close it as quickly as possible. I would say 2 to 3 months. I would like to close it before March, but we are a going concern, so if it slips into April, I do believe, look, as long as we get the right deal between March and April, honestly, I'm not too fussed. We'll try and close by March itself. Unlike Cinderella's chariot, I'm hoping we won't turn into a pumpkin on 31st March.
Okay. And so just considering now, obviously we're in Mumbai, Pune has been our focus areas, as you have said, for acquisition. Now, considering that now a lot of listed peers, right, even unlisted guys who are still there, the larger ones, there seems to be a lot of competition for the land, right? People are aggressively chasing a lot of land bank. So what does this mean for land prices, and how are you working around ensuring that margins are protected in the rising cost environment?
Yeah, that's a great question. Yes, there is certainly a lot more interest and activity, and as we all, I'm part of it, all of you are part of it, talk up the bull run in the real estate, more people start getting interested, and there is froth that gets created from a land acquisition perspective. So we are starting to see more activity from a competitive perspective. But that being said, I think landowners over the last several years have learned their lessons and do definitely favor the larger, more well-established corporate developers, because they believe there is a greater surety that the transaction will actually be consummated. So we have seen over the last year several rebound transactions that have come to us where landowners have signed up with somebody, that deal has not been consummated, and then they're back in the market 2 years later. So I think that lesson is in the minds of landowners. So they do deal with people like us differently from the others. I'm hoping that will continue to stand us in good stead. The combination of, though, as you rightly pointed out, heightened interest in land and input cost inflation is putting pressure on margins. We are countering that in 3 or 4 different ways. One is clearly looking at sharper design, so more efficient plans, trying to get better area efficiencies, etc., value engineering. The second is around contracting and procurement. How do we consolidate? How do we group kind of commodities that we buy, but also finishing materials we buy across projects so that we get better prices? The third is pricing. As I mentioned, there has been a perceptible hardening in pricing across the market, but within our portfolio, certainly we have a discipline of taking price up every quarter by at least 1.5% in each project, and many projects have done much better than that. They've gone up by about 8 to 10% over the last year. And the last one, which I think is particularly important for players like us, is how do we bring our advantage on cost of debt to bear? This is a capital-intensive industry. As Vimal pointed out, our consolidated cost of debt is 7.2%. Most of the peers are at 10, 11% plus. That has got to count for something. So as we look at how to leverage that from an economic perspective, I think these 4 levers are what we are working on.
Okay, thanks. That is pretty helpful. And if you just help us understand cumulatively, let's say 9 months of this year, what would be the total input cost sort of inflation, and what has been our corresponding price hikes we have taken across projects, some broader sense?
Generally, the input cost would have gone up if I look at it as a percentage of price. So the impact on margin would be about 300 basis points. Our average price increase would be well above 5%.
So is it the cost would have gone up by 8% and price hikes of 5%? Is that a correct understanding, or?
No, I'm saying input cost if I take cost as a percentage of sales value.
Okay.
The impact on margin is about 300 basis points, I'm saying. So 3% of margin impact because of cost inflation. And we've countered that by just the single lever of price increase, which on an average has been about 5%.
Okay, so there has been no hit on margin, so no net basis. That
yes.
is
Yes.
Fine. I'll come back. I have more questions. I'll come back in the queue. Thank you.
Our next question is on the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Arvind. Congratulations on a good quarter. So my first question, just to clarify, was that you said 2,000 crores was the GDV before March, and after that, beyond that, you have another 8,000 crores of potential prospects pipeline, which you will close it at 25-30% strike rate for the next year, so which will be like well above your 2,000 crores target for next year. Is it right?
Yeah, so advanced pipeline of 2,000 crores, as I said, we'll try and close it by March, but even if it spills into April, it's not the end of the world, but we will try and close it by March. The pipeline beyond that, the 25% I was saying was more of backworking to say even if the strike rate is 25%, we'll be in excess. I'm hoping our strike rate will be much higher than that.
That's for the next year. So maybe this year 2,000 maybe spilling over to April, but after that next year another 2,500 crores, 2,000 crores plus maybe next year from the pipeline which you have. Okay. Yes. The second question is on, so we've been booking very strong sustenance sales of averaging about 250 crore a quarter, with not many launches in place. So now this is a launch heavy quarter. So if you can highlight in this quarter what are the expected launches and in terms of GDV value, what these launches will be, and will this be maybe historically we have done highest about 400 crores, 407 crores. So will this be a quarter where we will cross 500 crores of sales?
Yeah. So Parikshit, as I said, this quarter we just launched Mahindra Happinest Kalyan 2, which is our second project in Kalyan, which literally this weekend we launched it. We are expecting to launch the last phase of Alcove, the next phase of Lakewoods in Chennai, as well as Luminaire Tower B, which is the third tower in Luminaire. Luminaire will be about 400 crore GDV, which we will bring to market. Happinest Kalyan, Happinest Kalyan 2, the first phase is about 350 crores again. Lakewoods, Sumit Vimal, about 100 crores in Lakewoods, again about 100 crores in Alcove. So those are roughly the numbers that we will market.
So it's about 750, 800 crores. So we look at crossing 500 crores this quarter in terms of sales?
Inshallah.
Okay. So earlier in their opening commentary, you did mention about a bullish upcycle which is there, which you likely believe that will be there for another few years. So just wanted to pick your brains on how are you positioning this cycle to the group, M&M, and do you think that any announcements to come through on the M&M family land over the next 12 months? And have you already considered a part of that while giving that 8,000 crores of prospect pipeline?
So, I mean, no further updates from what I've given you in the last couple of quarters. We are in constant dialogue as and when that opens up, we will certainly be in the running. Whatever is done will be done on a arm's length related party compliant kind of methodology. And so at this stage, that's all that I can share in terms of update.
Okay. Just lastly, on the industrial business, we did touch upon that international travel has seen some relaxation. So if you can build on how is the industrial prospect pipeline looking at, do you think that the momentum which we have seen in the third quarter can continue, or it was just more of a pent-up demand which we have seen covering up in big numbers in third Q? Or so if you can mention a little bit on prospect pipeline and then likely targets we are looking at for this business in the next year.
So as I mentioned in my opening comments, it's not a one-off. We are seeing continuing strength in that business. So this quarter also looks good that's a long sales cycle business. So often, what you sign up as MOUs in one quarter gets translated into lease deeds in the next quarter. So we are looking at, we already are sitting on MOUs which give us confidence that this quarter will also be strong. I don't want to share a number, but you'll be happy with the number is all I'll say.
Just lastly on the Ghodbunder launch, if you can touch upon what's the progress there and what are the timelines now you're looking to launch the first phase of this project? Is it like FY23 or early FY24? Some sense on terms of preparedness both from the design and approval stage and likely go to market and launch timelines if you can.
Thanks for raising that, Parikshit. We've had very good progress on the Thane land. Approvals are progressing well. We are targeting to do a first phase launch end of next financial year or first quarter of the following year. So Q4 of F23 or Q1 of F24.
Okay, great, Arvind. Those were my questions. I'll join the queue for more. Thank you, Ananda.
Thanks.
Thank you. Our next question is from the line of Janam Shah from Equirus Securities. Please go ahead.
Thank you for the opportunity. Sir, my first question is related to the land cost. So, sir, in presentation we are showing that some 2,600 crore of cash flow is expected from all the projects pipeline from the residential business. So how much land cost yet to be paid, including FSI cost and all other related cost as on date, like new land purchases and old some payment is pending. So in a number, what is the land cost to be paid yet?
So that's not a significant number. Having said that, I'm referring to the core land cost. What happens is, so far as FSI, TDR or incremental part is concerned, that gets spent as and when you are constructing, as and when you are launching the phases. But majority of the land cost is sort of paid for. Maybe we are short by about 40 crores or so in all these numbers. So far as land is concerned.
Okay. And sir, this the calculation of 2,600 crore that cash flow is showing for the residential business, does it just MLDL share in all the JVs, or it is in total that we are expecting, including the partners, JV partner share?
This includes the JV partner share, so in the top line as well as in the cost and therefore in the net number as well.
Okay. And this that TDR and FSI cost, is it part of construction cost, or is it over and above that? And is it also include admin and employee cost, or it is just a pure construction cost?
You're right. You're right.
It is at a gross margin level, Jainam. So all the TDR cost and related payments and all the COCs and approvals and all is part of construction cost. What it does not include is the below the gross margin line item, which will be, let's say, the sales and marketing cost and admin cost and all.
Okay, sir. And sir, the launch pipeline of that 5.92 million square feet, including all the current phases. So how we are targeting this launch pipeline to be launched, like within next 3 to 4 years, or in any guidance, like you have given like 4Q and 1H, there will be around 1,700 crore of launch. So how this launch pipeline will be entirely consumed in next 2 to 3 years?
I think all of this should certainly be brought to market in the next 2 to 3 years. There's nothing that our business model and our approach to the residential business is to kind of monetize land as quickly as possible. So we don't buy land to hold it. So it's only a question of absorption in the market, which will help us open subsequent phases in existing projects.
Okay. And sir, may I know the million square feet launched in the recent project of Kalyan? Like it is overall project is 1.1 million square feet, but I guess some phases has been launched. So what has been launched and how much is still pending?
What we have launched is the overall project has about 1,500 odd units, of which we have opened up 900 units, which is registered.
So about 70%.
So on the area basis of 1.2 million square foot, 0.7 million square foot approximately is opened up as phase 1. And this is the response of phase 1. Phase 2 will be opened up maybe next fiscal.
Okay. Thank you, sir. Just a last question. Like if we see the completion during these 9 months, so it has been a lower side. So and the completion that you are talking about in the next quarter. So is it safe to assume that it will be crossing over the total 9 months in million square feet or in overall value terms? Like many RERA dates are coming in this particular quarter.
So during Q4, we are expecting completions in the phases of Bloomdale, Centralis few phases, Lake Roots, couple of towers, and Roots is also in a touch and go situation. So I think we are talking about multiple completions, and Palghar, of course. The Palghar, which was Palghar 1, which was launched, balance completions are expected in Q4. So we are probably talking about more than 500,000 square foot of completions across all these projects during Q4.
Okay. That's it from my side. Thank you, sir.
Thank you.
Yeah, thank you for the opportunity. My first question is on your industrial clusters. Can you give more color on what kind of inquiries are you seeing there? Are they more from multinationals, domestics, and what is the run rate of inquiry versus the pre-COVID levels?
Yeah, Puneet. So it's actually a good mix of both multinational and domestic clients. As we had discussed, the strong focus around promoting manufacturing investment in the country through either PLI schemes or other state-level schemes is bearing fruit. So particularly in Jaipur, we've had a good mix of Scandinavian clients, Indian clients, largely so far heavily skewed towards our domestic tariff area. The SEZ, there has been 1 or 2 sign-ups, but that has been a smaller part of the volume.
Okay. And the run rate is significantly better than pre-COVID now?
Oh, yes. I mean, so the last quarter, Q3, was higher than the entire previous year and the year before that as well. So I think, and as I said, Q4 is going to be strong as well. So we are certainly seeing a bounce back in manufacturing investment. There was a period of about 4-5 years when, as a country, we were not attracting enough manufacturing investment. We are seeing that story turn around quite dramatically.
Okay, excellent. That's very useful. Secondly, on the residential demand, can you give some color on what is the quality of this demand? Is it more end user base, or are you seeing investors coming back in the market?
I think for many years now, at least 2-3 years, we are seeing a more end user based demand now. End users, one has to qualify the term. It is for self-use. Sometimes it is also for something that they buy to bequeath to children, etc. So it's not always self-occupied. But the earlier behavior of buying just to flip property as soon as it's ready, that has gone away almost completely from the market. I don't see that kind of demand in the market.
Okay. And in terms of price increases, do you see room to take further price increase?
See, as I said, our discipline and our business model is very clear that we will have a steady price increase quarter on quarter. This is not just important for our economics, it is also important from a consumer signaling perspective, because otherwise why would, as we just discussed, if it's an end user, why would he buy during a construction cycle if the price is not going to go up successively until possession? He might as well wait till possession to buy it. So we are, therefore, our pricing strategy is very clear. We will price it at an attractive level at launch. We will steadily take price up so that by the time you reach OC, there is a very perceptible price increase. So customers who bought with us in under construction, at launch and etc. and sustenance do feel that they've actually done a good thing by buying with us early.
So what kind of price increase do you plan from launch to OC stage?
Our thumb rule, as I said, is 1.5% per quarter. We try and do more than that, but the default is 1.5%, and there has to be a strong reason to be below that in any project.
Right. So basically, by the end of the project completion, if nothing more, at least 20% plus price increase should have definitely happened.
Yes, that is the intention.
Okay, understood. That's very helpful. Thank you so much, and all the best.
Thank you.
Thank you. Our next question is from the line of Prakash Kapadia from Anivet Portfolio Managers. Please go ahead.
Yeah, thanks for taking my question. Most of the questions are answered. I just had one question. Bombay and Pune seems to be our focus area on residential. So have we identified some newer micro markets where, we were not there, or is this cluster approach enough for us to grow in the near term in Bombay and Pune?
Yeah, so Prakash, within Bombay and Pune, we've identified certain priority micro markets that we want to double down on. Some of that is kind of self-selection because of the segments that we want to work in. As we've talked about in the past, we want to be bringing products between about 30 lakhs to 3 crores, 2.5, 3 crores. And that self-selects markets, particularly in Mumbai as well. The price distribution is quite linear from south to north. So in Mumbai, we are looking at markets in the western suburbs like Kandivali, Borivali, Dahisar, Andheri East, etc. On the central side, it would be Chembur, Mulund, Thane, and in Navi Mumbai, certainly Vashi, Sanpada, Nerul. These are all important markets for us. In Pune, it is a bit more geographically distributed. We like Pimpri, where we've done 3 or 4 very successful projects. We're looking at Mahalunge, we're looking at Mundwa, we're looking at Hinjewadi. These are the key markets that we're looking at.
Understood. Fine. That's it. Thanks.
Thank you. Our next question is from Prem Khurana from Anand Rathi. Please go ahead.
Yeah, hi. Thank you for taking my questions and congratulations on a good quarter. Sir, was wondering, if you could share your thoughts on the supply side. Not from the company perspective, but more from industry perspective, because I think there was a media article yesterday wherein it seemed as if BMC has approved more than 2,500 or 2,400 odd projects with 15 crore square feet kind of additional built area. And what we've seen in the past is essentially some of these real estate cycles tend to go bad because not because the demand goes down substantially, but because of the oversupply situation wherein there tends to be some pricing pressure and people start cutting prices. So would you believe that this entire 15 crore square feet will hit the market and there could be a an issue with the pricing action going forward, or do you think, I mean, a large part of this would not come to the market only? I mean, this is only approvals, and then some of these people won't be able to kind of hit the market.
Sorry, Prem, your voice is getting a bit muffled. So you were asking about the.
So I was asking, I mean, if so we generally, I mean, tend to focus more on the demand side of the business, right? But when I look at supply, I mean, supply again is an integral part of the real estate value chain or real estate cycles that we tend to have, right? And there was a media article yesterday wherein it seemed as if PMC last year, seems to have approved 2,400 odd projects with 15 crore square feet of additional built-up area.
Okay.
And now, assuming this entire thing will hit the market, I mean, could there be a situation, I mean, we would get to have the repeat of the last cycles wherein oversupply came to kind of hurt the real estate cycle and not any significant slowdown in the demand?
No, I think that's a great point. Look, I think there are several things happening in the industry. One, there is a very clear formalization of the sector, particularly in the residential real estate market, where customers are preferring to buy with, particularly for new launches and under construction, with credible developers who have a track record of delivery, who've not kind of walked away from projects if they're facing financial distress, etc. I think that has become a very marked trend in the under construction, so pre-delivery sales. Post-delivery, of course, there is a bit more confidence that the customers have. As long as the product is standing and it's good and its quality is okay, then they're willing to take a risk with local developers. So yes, there's been lots of approvals given. How many of these actually get built and launched and delivered remains a question that we will have to watch. As I had commented in response to one of the early questions, which was on land acquisition, unfortunately, our category is very sentiment driven. So when there's an upswing, everybody wants to enter. When there is a down cycle, everybody wants to stay away. And because now there is a belief that real estate is on an upswing, you do have, the fringe developers who are sitting by the sidelines, wanting to throw their hat into the ring and develop. Some of them might succeed, some of them might fail. Very early to say, but the market has learned its lesson over the last cycle of ups and downs. So I expect those lessons will be remembered.
Sure. And in our notes to accounts, we seem to be planning to kind of amalgamate some of these subsidiary companies, MITL, MRDL, with MWCDL. So any change in thought process for MITL? Because I thought it's largely meant for social infra, which is where, you'd get that entity separate because you want to distinguish between IC and ICN and residential or social infra, which is why the land was transferred to MITL. So why are we kind of planning to merge it back with MWCDL? MRDL is not a problem because there's hardly anything left. So yeah, MITL especially, if you could clarify, please.
You're absolutely right. When we had called out these entities about 10 to 12 years back, they were SEZ-related requirements of, for example, having a co-developer, or you need a separate entity in case you are bringing in an investor or creating a platform. Subsequent to that, there are developments happen where the guidelines have changed, and today when we filed for this merger, we believe that there is a opportunity to optimize on cash streaming, tax optimization, and leveraging or extracting value once we merge it. And based on these considerations, we have gone ahead and done the filing. The thought process continues to remain. Whatever is a residential area will be developed as residential. Whatever is commercial will be leveraged as commercial area. So no loss in value. We believe that it will lead to higher value creation once the merger comes through over the next 6 to 8 months.
Sure. But if you were to do that, it won't come as a part of, you won't be able to consolidate on a line-by-line basis, right? Because MWCDL, you're not allowed to consolidate because you don't have the full management control there, although we own more than 70%, but us are the 89%, yeah.
Right. The choice was between top line and bottom line. We selected bottom line.
Sure. No problem. And just one bookkeeping, Vimal, I think our net debt consolidated that you report, I understand, it doesn't reflect the true picture. but seems to have gone up by some 20-30 odd crore rupees during the quarter. And in this quarter, I think we received almost around 50-55 odd crore rupees from Luminaire entity as well. I mean, there was a buyback. Why this, I mean, eventually net debt would go up, and if we could manage to have 50-60 crore rupees come to us from Luminaire, and we have done good in terms of cash flows even otherwise. So was there any land payment during the quarter which would explain this slight rise in our net debt number?
Yeah, so look at it from two perspectives. One is that look at a little longer time horizon, starting 1st April to say 31st December, you will see that all entities put together, there is a debt reduction that's coming on the back of huge operational cash flow which is coming. The operational cash flow positive for 9 months is upwards of 500 crores actually. Part of that has been paid back to the stakeholders and the shareholders, and part of that has been paid back as debt. On 3 months basis, you will never be able to make out as to how the numbers are it moving positive or negative, because there are intercompany loans and stuff like that which moves. Having said that, obviously one is building up cash in anticipation of adding GDV in the next few months, as Arvind mentioned in his opening remarks. So that continues to be a key priority for us.
Sure. Thank you. That's it from my side, and all the very best for future.
Thank you. The next question is from Shreyansh from Equirus Securities. Please go ahead.
Thank you for the opportunity. Sir, my question pertains to, the questions which were asked by the earlier participants. So if I just do a rough math, in terms of the cash flows which we are expecting, so of the 2600 odd crores, if I remove the admin cost and share of JV, I'm coming at a number of, say, roughly around 2200 to 2100 odd crores. And if I discount it at the current rate, it's coming at around 1600 odd crores. Is my understanding right?
Yeah, Shreyas, I think overall admin cost over the next 3 years should be about 400 to 500 crores, and share of JDs should be around 250 crores in that number. If you subtract that, and then taxation, I think is a different ballgame altogether, because we have some accumulated losses and all. We'll have to see how that really pans out. We are not expecting too much of tax out. So I think net number, what you're suggesting, 1500 crores seems to be on a conservative side, but right.
Got it. And sir, what would be the price hike assumption which we've taken for, coming to this number?
Nil.
Okay.
Yeah, as of today's prices, what Arvind mentioned, reasonable price increase is something that will definitely improve the overall top line. So the estimated sales value should increase. Even the construction cost is also something that we have estimated as on today. So we'll have to really see how that equation plays out, but we expect to do better.
Got it. Sure. So my second question, pertains to the IC and IC business. Here again, in terms of the cash flows or the numbers which we are expecting, it suggests, the ballpark that we are expecting roughly around 8 to 10% increase in terms of realization to around 30 million on an average. Whereas if you see our 9 months performance, it's more or less that 25-27 million number. So is it fair, or probably is it, do we think that we can reach to that number?
There are a couple of points here. You are referring to the blended numbers, right?
Right.
Now, the sheer fact that it's blended, it will mean that your number may move because of the mix impact. The overall portfolio which we are holding actually moves anywhere between 1 crore to about 4 crores an acre. And to that extent, if the mix is different, then the realization will be different. Apart from it, we are usually experiencing price escalations and better price realization on the IC side of business as well.
Okay. Got it. Sure. And last question from my side, sir. Any updates on the SEZ contingent liability which we have?
You're referring to Jaipur?
Sorry?
Which entity you are referring to, Shreyans?
For the IC and IC business. Well, we have, in that IC and IC business, we have a contingent liability, I guess, if I'm not mistaken, in the Chennai.
Yeah, so absolutely no change in the status on the contingent liabilities of Chennai.
Okay. And, sir, if I may add, post this budget, announcement for the SEZ benefits, will things change for this contingent liability, or it will be status quo?
No, the two are not connected.
Okay. Okay, sir. That's it from my side. Thank you and all the best.
Thank you. Next question is from Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi, good morning. My questions are pertaining to the industrial business. Firstly, we are seeing substantial traction in Jaipur DTA especially. So any sense on going forward, how will the SEZ area pan out in terms of leasing traction?
Yeah, so look, I think SEZ, because of the sunset on the SEZ clauses and the fact that SEZ units so far don't have the flexibility to serve domestic markets, SEZ in general have seen lower demand. And with the proposed changes in the legislation and the early signals we're getting is one of the key changes is going to be allowing SEZ units to serve domestic markets. I think that will be a game changer for the SEZ, because then actually SEZ becomes more attractive than DTA, because it gives you the benefits of an export-oriented unit plus using the same facility for a domestic market. It creates manufacturing efficiencies and optionality to serve both markets. So that's something that we are eagerly anticipating. Now, depending on the timing of when that legislation is introduced and approved, I believe that could be a significant upside in Jaipur.
So till then, the DTA business is likely to grow?
Yes, we are seeing stronger demand in DTA.
Okay, understood. Secondly, Chennai saw a cancellation of around 3 acres. So anything to read into it? What type of customer was it? Any further cancellation expected anywhere?
No, this was a one-off. So that particular customer was in financial distress and had to cancel the deal. If you look at the last several quarters, it's very rare that this happens. So.
Sure. And lastly, Ahmedabad, are you able to finalize the anchor tenant, or what sort of demand are you seeing right now?
Not yet. Again, active discussions underway, but we still don't have wet ink on paper. So continuing to work towards that.
Sure. Thank you. That's all from my side. All the best.
Thank you. Next question is from Pritesh Sheth from Motilal Oswal. Please go ahead.
Hi, sir. Thanks for the opportunity. So, two questions on your 8,000 GDV pipeline that you indicated. Firstly, how is the mix across Mumbai, Pune, and across the the project that you are targeting in terms of outright land acquisitions, JV, GDAs, where it is more inclined towards?
So I would say about 50% of that is outright, between either clean outright where we do the approvals or outright where the landowner does the approvals and then we buy it. So some combination of that would be 50% of the pipeline. And about 25% is society redevelopment, which is becoming very active and very attractive, particularly in the city of Mumbai and Navi Mumbai. And the rest would be a combination of JDA and distressed.
Sure, that's helpful. And Mumbai, Pune equally poised, or is it still heavy in Mumbai?
I would say currently about 60-40, just because in Mumbai the values tend to be higher, the prices are higher, etc. Yeah. Not from an acreage perspective, but certainly from a GDP perspective, it's 60% Mumbai, 40% Pune.
Sure. And how much would you be spending on acquiring this 8,000 crore pipeline over the next 2-3 years? What's the estimation from the mix that you are right now still looking at?
Yeah, look, firstly, it's highly unlikely we will acquire 8,000 crores. As I said, that's the pipeline. There will be a certain strike rate on that. I hope for a good strike rate so that we can pick and choose the ones that we really want to pursue. But thumb rule, I would say, blending across Mumbai and Pune is about between 15 and 20% of top line is the cost of land.
Got it. And are you seeing any increase in terms of land prices or JV partners asking for a higher share, anything of that? Because now, if you see from the organized space perspective as well, most of the developers are looking at strong business development over the next 3-4 years. So looking at the competition and looking at the choices they have, are you seeing any increase in terms of price or share for the partners?
As I mentioned earlier, there is certainly hardening of prices and stronger negotiations happening from the landowner's perspective. A year back or a year and a half back, there was more desperation on the part of landowners. today they are holding out for their expected price. We're even willing to wait till they get the price that they expect. So to that extent, yes, there has been some hardening in price on the land side. But look, one should see this in perspective. If land cost is between 15 and 20% of the top line, even if land cost hardens, it will harden by another 10%, let's say. That's about, let's say 1.5 to 2% of margin impact. And one should be able to cover that in between price and cost efficiencies. One should be able to cover that. So I'm not, yes, it is happening, but I'm not unduly worried about it. Is the summary message I wanted to give you.
Sure. Thank you. That's very much helpful. And all the best. That's it from my side.
Thank you.
Thank you. The next question is from VP Rajesh from Banyan Capital. Please go ahead.
Hi. Thanks for the opportunity and congratulations, Arvind. Most of my questions have been answered, except this one. If you can comment about your distribution network, because I know last year you were quite focused on building that up, and if you can talk about how it has shaped up and what are the benefits that we are starting to see from that.
Yeah, thanks, Rajesh. So the clear visible benefit is the strong sustenance rhythm we've been able to build. Doing roughly 250 crores in the quarter, which is about 85 crores a month, purely on sustenance sales with no new launches is testament for the strength of the distribution channels that we've built. In Mumbai, we now cover, I think we have something like 3,000 plus active channel partners on our network. We've also built a lot of strength around our pre-sales and digital capabilities, as well as corporate and loyalty. These are the three main sources of leads and walk-ins that we have. So all three are firing quite well and moving in the right direction. In markets like Pune as well, our launch in Tathawade last year, in February last year, was a large part of the success was attributable to the strength of the distribution. We had over 1,000 channel partners working on that project, and that's what helped us sell about 80% of the inventory at launch. Even in a market which is less distribution heavy like Chennai, Mahindra Happinest in Mahindra World City Chennai, which we launched in August, we had almost 60% of sales being done by channel partners, which in a Chennai market is unheard of. That tends to be a market where it's about a 30-40% share of distribution and the rest is direct. So this has been as you rightly pointed out, an area that we've systematically built depth. We continue to engage with our channel partners. We have developed a channel partner app to keep them engaged. And as we put more products into the kitty for them, we will become even more relevant to them. So that's the reason for our geographical focus in Mumbai and Pune. One of the strong reasons is so that we have more relevance and more salience with our business partners, which is our channel partners.
That's wonderful. Just a quick follow-on on that. Are you seeing a skew towards digital platforms like your 99 acres or housing.com? Are they becoming more important to our business, or still it is more mom and pop real estate agents?
So digital in general is extremely important. So even our channel partners are now sourcing leads primarily through digital outreach. The large channel partners all have sophisticated search and other capabilities to generate digital leads. Our direct contributions from platforms like 99 acres, Magic Bricks, Housing, etc. Is not much, because they tend to focus not on developer sales but on direct sales of their own secondary market transactions, etc. So we don't have a significant dependence on those portals.
I see. Okay. Thank you. All the best.
Thank you.
Thank you. We'll be taking our last question. That is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, thanks for the follow-up. So my question was on the preparedness and readiness for the Dahisar launch. So what kind of timelines we are looking at?
Probably Q3 or Q4 of next financial year. We are very advanced on design, and so we expect Q3 or Q4 next year to.
Okay. And just last thing on the redevelopment. So how does the process of DD work in a redevelopment? Do you enter into a MOU first and then you wait for clearing of the societies and then you announce it? So what how different is that PD process followed in redevelopment versus traditional buying out of land or partnering with the landowner for an existing land?
Yeah, so the redevelopment projects, society redevelopments are much longer lead time than the traditional land purchase. But in a city like Mumbai in particular, the two sources of land going forward are going to be one, societies which are wanting to redevelop, and two, industrial land which is getting converted for residential. So these are important focuses, and that's why we are building our capability around society redevelopment. The process tends to be, very often the society will appoint a PMC who will run a tendering kind of process. They will shortlist a developer. At that stage, the developer needs to present a proposal to them. You end up negotiating on how much additional area you'll give to the current inhabitants, what is the phasing, when will they be displaced, what is the rental that you will provide to them in that time period. So it's a complex set of negotiations with multiple members of the society. It's not just negotiating with a managing committee, etc. It eventually gets presented at a special general meeting. When they approve it, then the agreement gets registered. So it's multi-step, at least a 9 to 12 month process before you can get to something which is definitive, which we can announce. We prefer not announcing things which are just at a term sheet or MOU level. We want something definitive before we announce it.
And lastly, what will be the redevelopment MOU with you right now, wherein you are negotiating or you are discussions with the tenants and all, and maybe in 9 months it will reach to the timelines of getting announced?
Sorry, your question was what is the redevelopment value?
So I was asking you, what is the total MOU you have entered into the society for redevelopment, which may get fructified and get announced over the next 9 months as of now?
Look, as I said to answering an earlier question, out of the 8,000 crores that I indicated our pipeline, about 25% is between a society redevelopment. So you can look at kind of roughly.
So that's a MOU you have already signed with these societies?
Those are advanced discussions. They're not necessarily MOUs we've signed yet.
Okay. Is there any number of MOUs which you have signed in the MOUs?
No, difficult to share that at this stage.
Okay. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Arvind Subramanian for closing comments. Thank you, and over to you, sir.
Thank you. So thank you everyone again for joining the call. I think just to summarize, we are seeing strong tailwinds in the sector, and both the segments that we are exposed to, which is residential, housing in the value segment and the mid-market segment, but also the industrial parks business, are seeing strengthening of demand from a structural perspective. So I do expect the next few quarters to continue to be strong. The focus of the management team is to build capabilities and strength steadily, so that quarter on quarter we can keep showing strength and improvement. So I would request and kind of request you to indulge us with your patience. You will see visible results, but stay with us because I think we are on a good wicket, on a good trajectory. Thank you again.
Thank you very much. Ladies and gentlemen, on behalf of Mahindra Lifespace Developers Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.